in funds management. So the reason I set up FXWW almost sort of 15 years ago now, originally I set it up to help interbank traders, ex-interbank traders who wanted to get into funds management. But more recently, in the last 10 years, I've recognized that there's a huge gap in the market for finding new trading talent. The banks are not, pretty much since the global financial crisis, banks are not training any traders anymore. So the only place where the new trading talent can come from is the retail space. So for the last probably 5 to 6 years, I've been concentrating on the retail space, working with them, developing talent. And that's why when FP asked me to present this webinar, I was more than happy, because I get to talk about a pet peeve, if you like, of my own, or a pet. I hope you understand the word peeve, but something which sort of frustrates me a lot, and that is that so many participants in the market are acting like analysts and strategists rather than traders. So that's what I want to talk about today. What I believe is the skill of trading, which is in building positions, and rather than sort of the skill of analysis, which is I believe a different skill set. So look, at this webinar is probably likely to blather on for about 45 minutes to an hour, and then when we're done, we'll take some questions after that, if that's okay. So yeah, if you wouldn't mind just hanging on to the questions for a while, and then we'll get to them shortly. So here I'm sure you're able to see my screen here. So we'll start. This is going to be the schedule, and then we're going to look at we'll have a brief look at some charts, because we'll just look at some potential sort of trade ideas to see how we would go about building a position based on those ideas. So the first thing we're going to talk about is trader or analyst. Now, when I started working in banks back in sort of the mid 1980s and even through say 2010, treasury departments were made up of plenty of different people, and on one side you had the strategist, the analyst, and the economist, and their job was to figure out, to a large extent, where the market was going. They provided research, obviously, to the customer base, and they provided research, and they provided ideas to the traders. But the trader, was a different animal, if you like. The trader's job was to maximize profits based on, I mean, obviously you had flows coming through, and that's one thing that sort of a retail trader doesn't have, but also to take proprietary risk on the bank's behalf and utilize those ideas to maximize profit. And that is, I believe, the skill of the trader. And in all my years working with banks and institutions, I don't think I ever saw one bank issue a trading limit to an analyst or a strategist or an economist. That was not their skill. Yet, in what I see in the retail space is that a lot of, in fact, the majority of the participants seem to be concentrating primarily on being analysts or strategists. They're trying to pick a winning trade, whereas what I believe the trader should be doing, or a successful trader should be doing, is not only is picking a winning, is obviously you got to pick a winning trade, but then absolutely maximize the profit to the nth degree based on that trade idea. So minimize the loss and maximize the profit. I know it sounds very cliched, but that is the skill of the trader, and most people don't have it. It's a very, very rare commodity. I find in my space where I work in now, I'm looking for developing trading talent, and the really good ones, they make so much money for themselves, they're not interested in managing any money for me. So it is a very, very rare skill, and the ones who have it tend to make a lot of money. So first and foremost, I would say we need to differentiate between being an analyst and being a trader. So I know for a retail guy, you're probably going to have a little bit of both hats on because you don't have a resources to employ analysts or strategists. So you are going to have to come up with your own trade ideas. But look at worst case scenario, toss a coin. I mean, really, that's that's sort of what we're talking about. So you look at the fundamental side, and you look at the technical side. You pick an entry level, and based on that, then you formulate a trade. So that's where we're going to start really today in looking at the building of a position is in formulating the trade. So let me just move straight down here. Now, I'm going to complicate matters a little bit because obviously everybody's a little bit different. There's there's some guys who trade very, very short term and some guys who trade sort of much longer term. But nonetheless, the underlying philosophy, in my opinion, should be the same. We're looking to, regardless of whether the time frame is very short or very long, we are looking to manage our risk and then to maximize our profits. So I'm going to look at two particular trades here. The first one is a sterling Swiss trade that I have been working on probably for the last sort of 3 or 4 weeks. And secondly, we're going to look at actually we're going to look at an Aussie dollar trade. It's not an Aussie yen trade. Apologies for that. But yeah, we're going to look at a shorter term trade, and it's just going to be a theoretical trade. We're just going to sort of make it up as we go along. But it'll just give you a sense of how to potentially maximize your profit on a trade. Now, this isn't going to happen all the time, and that's couldn't be the case. A professional golfer doesn't tee it up and win every week. That's just not what happens. But when you win, we want you to win big, and when you lose, we don't want you to lose very much. And if that's what you're able to. If you're able to develop those skills, you will be a hugely successful trader. So first and foremost, now just let me say, I'm going to be hopping around a little bit here between so this is the slideshow here, and then I've got what I call a positional blotter, which is something that I like to work with at all times, even though I know all of the all of the trading platforms will just show you your position. Like on the platform, I like to actually have my positional blotter in front of me when I'm trading. So it just gives me a better feel for exactly what I'm doing. So look, that's maybe just old habits, but I think it's valuable for me, and I think it's a valuable exercise for the purposes of this anyway. And also, we're just going to have a quick look at maybe some charts as well. So just that we can. Just so that I can sort of show you what I'm, what I'm talking about. So let's start with a practical example, and we're looking here at sterling Swiss. Now, look, without going too much into my reasoning behind it, I had normally there's 3 factors involved for me. There's fundamental, there's technical, and there's market, and they're the 3 main ones I look at when I'm trying to come up with a trade idea. And in my view, from a market perspective, the market was overly bearish and short of sterling. Structurally, I believe the market was also particularly long of Swiss franc on that safe haven trade. So from a market perspective, I felt that sterling Swiss was due to move higher. And so I felt we could, move back up to levels up here somewhere in the mid 140s somewhere, right? So at the time we were trading down here, say 127 for the purposes of this exercise. So I come up with an idea that this market is going to move from 127 to 142. So that's the simple. So I've got my idea in place. Now we have to decide what are we going to do about it. How, based on this idea, am I going to maximize my profit and minimize my losses? Now I'm going to need a little bit of luck along the way. Don't get me wrong, but what I want to do, I'm just repeating myself here again, is maximize my profits based on my idea to start buying sterling Swiss around this level, around 128 the figure. So let's go back to the position builder, and Now, we're just going to start putting in some numbers here, then, just for the purposes of this exercise. So first thing we need to decide, let me go back to my screen show here, my slideshow, is we need to have, I believe, a defined monetary risk per trade idea. So regardless of whether this is a long-term or a short-term position, and we must have a defined monetary risk. Now, it will vary, a lot depending on whether I'm placing one trade per month or whether I'm placing five trades per session. So obviously that's going to be a big difference. But coming back to what I can afford to take, I must decide what that number is. So I go to I'm looking at my charts, and I am, for instance, looking to buy sterling Swiss at 128, yeah, and I say to myself, I can afford to risk, let's pick a number. Let's say I've got $20,000 in my account and I can afford to risk $1,000. I think my worst, I'm a bit of a medium-term trader. My worst ever run in terms of losing trades was 11 in a row. So if I were to lose 11 in a row with a $20,000 account, and I was losing $1,000 every time, that would be a total of $11,000. I would still be in the game. I hope that makes sense. So I have to base my this monetary amount, the amount I'm willing to risk, I base it off obviously my previous experience in my own trading, how I trade, how much money is in my account, how much can I afford to risk. All of these questions need to be answered. So let's say the market is trading at, say, 128. We're just picking numbers here, remember, 128.15, and I can afford to risk $1,000, let's say. Going back to my chart, we were trading, let's say we're trading down, let's say we're trading here. It was on this day, let's say, again, this is just for purposes of the exercise. I decided that I'm going to start buying here at 128.10, and I have to look at my daily chart and see, well, where's the downside risk for me? So remember, this stuff hasn't happened yet. We're still trading down here. It has been down to 127.50. It started to put in an hourly base, if you like, around here, and I decide I want to start buying. So how much do I buy? And it's a hugely important question. Do I just go and buy 5 lots? Well, I could buy 5 lots and I could get very, very lucky and the market goes up straight away. On the other hand, if the market drops 100 pips, I will lose, $5,000, which is, a quarter of my account. Am I willing to do that? Is that a good trade? It doesn't seem like a good trade. I'm putting all my eggs on one random trade, so bad idea. So I've got to decide what is that amount I'm willing to invest at this stage, and I'm going to talk about the golden rule in a few minutes. And the golden rule for me is don't get stopped out. I know that sounds a bit ridiculous, really, but believe me, if you do not get stopped out, you will make a lot of money. So if we play good defense, we don't overuse leverage, we keep our positions manageable, then we should be able to avoid getting stopped out. So I'm trading it, and again, for the purpose of this exercise, we had a sort of a double bottom here, broke up above a neckline here, say 128-ish, and made a new high, retraced, hung around here for a while, and I decided I'm getting in. But I need to have my stop loss, say, to be sure, down here somewhere, 126.75. So back to my spreadsheet, I go long, we say 128.15, so now I buy a very small position. Yeah, I buy 50,000 at 128.15, and I've got a stop on that at 126.75. Off the top of my head, that's going to cost me about $750 if I get stopped out. And I have to decide to myself, is that a good risk? Am I willing to risk that amount? I say, yes, I am. Okay, I take the trade. So I can afford the loss, I take the trade. So we're in here somewhere, I'm 50,000 loss, I'm long, it's a very small position, but my risk is manageable. Okay, so then the market starts to develop. So I'm starting to see it go sideways, a little bit higher, and I'm thinking, okay, I'm starting to feel a little bit more comfortable with this position. I still need to keep my keep that maximum $1,000 stop loss in mind, but presuming the market hasn't run away from me yet, it's still trading around the same levels. And I know we've got a low here. So this is where the technical trading comes in. We do need to put a stop loss somewhere, and a stop loss where hopefully we're not going to get executed on. So here's a 127.45. I probably want to have my stop at least 30 points below there. So let's say I decide, okay, I'm going to buy another 50,000. It's developing. The market is starting to develop pretty much the way I wanted it. And yeah, so I've now, sorry, let me just get rid of these trades here. So at this stage, I've bought, as you can see from my position, I'm 100,000 long at 128.21, yeah, and I've got a stop loss 100 points lower, and that is the risk for me of $1,000, and that is, I'm comfortable with that. I've decided that that is that's a reasonable risk for me to take, and so two things can now happen. One, the market goes in my favor, or the market goes against me. If the market goes against me, I lose $1,000, and I'm willing to accept that. But let's just say the market starts to, as has happened in this case, this market starts to go in my favor. Now, this is where it becomes a bit less, yeah, we're reliant here on a little bit of luck for sure, in terms of adding to this position as the market starts to go in our favor. So we're going to need a little bit of luck. So normally, so I think in this particular instance, we had a move higher from sort of this 128 where we built our position, and we got to move higher up here to 131 wherever. So up around this level, 131. So the first thing we do when the market goes in our favor, we take a bit of profit. Don't add, I think, and you'll find some people who disagree with me on this, but I would not, first thing you do, you've got a profitable position, it moves into the money, take a little bit of profit off the table. Now, so I've now got, as you can see, I'm still only got a very small position. I'm 50,000 long at 125.42 average entry level, but the market is trading at 131. Okay, so I can sit back and think a little bit more about how I want this trade to develop. So we're still back in sideways motion. So we're doing sort of 131, and we get down to 130.50, back to 131, back to 130.50, up to 131, back to, and we're not making new lows. So this is remember, I'm bullish. So you need to have a view, and a pretty strong view that something's going to happen. And as I said earlier, I've got a pretty strong view that we're going significantly higher. So let's say, and the market's consolidating, and if this happens over a period of 2 or 3 sessions, you need to be buying again. We're professional traders. That's what we're in here to look for the right time to be buying in. So now I see this and I say, well, look, this is confirming everything I know. Look, I can also add other stuff in, like extra market information, changing the fundamentals that we saw with the Bank of England, turning more hawkish, that the tax reform stuff coming out of the US, which is likely to particularly affect the Swiss franc. All of these things are adding to my, store of knowledge, and I'm getting more bullish here. So we have a period of consolidation, and at some stage you're going to have to bite the bullet and buy more. So again, let's just say we buy at the same level. We don't even make any profit on that one, right? We've bought into the same level, but now I've got a position, I'm 150,000 long, average level is 129.14, yeah? Back to the chart again, remember. So yes, I could have bought 150,000 here at 128 and saved myself 100 pips. Yes, I could have done that. But I didn't know what was going to happen. Of course, I didn't know what was going to happen. And if the market had broken lower, I could have only put a 65 pip stop on that 150,000, and that's just too random. 65 pips is noise. It's just, the market, that's just market noise. So yeah, so that's just too risky. Whereas now I've built a $150,000 position, 150. I'm along 150 sterling Swiss on this trade at a reasonable level, and I'm 200 pips in the money, and feeling quite, feeling quite confident. Now remember this. So this trade goes my way. So this one starts to develop. So we break above that previous high. We make new highs, we reverse, we consolidate around that previous level. Now remember, I'm bullish, so I'm looking for levels to buy. I haven't had a strong spike higher yet. So if we get a strong spike higher, then I'm looking to take some profit. Like I'm talking about 150, 200 pip spike. But barring that, I'm looking at the period of consolidation. That's when I build my position. So now we're still hanging around this level again. I'm buying again. So remember, I think, so sorry, just to repeat that, we've made a new high here. We've pulled back a bit, but it's consolidating. It's the levels are holding, and I'm bullish, so I'm buying again. So let's call it, at 131.30. So now I'm 250,000 long at 130.04. So I can only have a 40 pip stop on that position in order to risk my $1,000. But I can have my stop. My stop is down here, yeah, way down here. So or I can put my stop at break even, and sometimes it's going to reverse and take me out. I mean that's the risk we take. That can happen at any time. So and there's nothing I can do about it if that happens. But as I said, I'm bullish. I believe the market's going up, and I'm going to stick with it. So now, rather than having a small long position at 128, I've now got a 250,000 long position at 130, and we're getting close to 150 points above, like profit that I'm in. So at this stage, I've made $3,500. So it's starting to look like a good trade. Now I'm just going to play around with a little bit of numbers because I don't want to spend too much time just looking at one example, but I just want to give you a sense of what it's going to look like if you're able to build this position properly over the next sort of the next phase. So we're looking at, so I'm hoping we're going to see a phase where this market moves back up here towards these levels, up at that's mid 140s, 142. Yeah, so 10 big figures high. So I'm looking for it to move 10 big figures high. Now watch what happens. So it goes up. So I sell 100. Let's see where it is now. It's now at 132.90. So let's say I sell at 132 now. Now look what's happened. So I'm 150,000 long, back down at that original level we were talking about, but it's been almost like a zero risk trade for me. Yeah, I hope that makes sense. So it's now it definitely is a free trade, and I can start perhaps trading a bit more aggressively. I've got more space. Yeah. So I've got more space on the downside. I've got plenty of space on the upside. And now what I really would like, so remember, I've got a $20,000 account. If I trade this really, really well, I would really like to end up with a $500,000 position here and a 10 big figure profit. Now, that might seem unrealistic, and it's very difficult to do, but it's certainly achievable. And I think that's the only way you can turn a 20 grand account into a 50 grand account on one move. Yeah. So you're going to need, obviously you need you need to get lucky to some degree. You need to pick the right move, and you need to get your timing right. But more than that, I mean, you're going to be lucky and going to be unlucky. That's just going to happen. You need the skill to be able to build this position over the time. So you don't panic. You look to build. So let's just look and see what happens. So we sell. And again, remember we're playing for a little bit of luck here. So we get back to the 4 hourly chart. let's say we get a pullback to these levels again. We sell rallies. Remember, we're selling rallies now, and we're buying dips maybe quite aggressively. So now we add 200 at say 31.90, for instance. At this stage, I've got a $350,000 position at 130.26. The market is trading at 131.90, and if I'm still willing to risk my $1,000, I can basically risk 30 pips on this. So I can have my stop just below 130, the figure. So this is, starting to look like a decent trade. I mean, there's no guarantee I'm not going to be stopped out. It may happen, but if it doesn't, and it keeps going, and it does what I hope it's going to do, I'm going to end up with the position I wanted. Now, let's just say I get lucky. I pick the bottom. It starts to turn again. Now we're going to get a little bit aggressive. 132.08, whatever. We buy 150,000. Now, look at me. I'm now 500,000 long at 130.80. I've got the market's trading at 132.10, and I can only afford a 20 pip stop on this. So I've got to put my stop at 130.60. Which is back down here somewhere. So again, look at you've always got to be comfortable where your stop is, and you've always got to be able to afford the stop. Otherwise, you do not add to the position. And we do tend to get overly aggressive from time to time. That's just the nature of the beast, the type of people we are, that we get overexcited sometimes. But just by building into this position, I started with a $50,000 position at 128.15. I've now got a $500,000 position at 130.80. I'm over 100 pips in the money. And yeah, just imagine what happens if that goes up 10 big figures. Now I can sit back, really now I can sit back and say, I've created the position I wanted. I'm risking the bank's money, if you like, or the market's money. It may turn down and stop me out. It may burn a hole in my pocket, and I'm just too, it rally, and this has happened to me on a number of occasions where I've managed to build this beautiful position for myself, and then it's gone 300 points my way, and I've got a big profit sitting on the book on a Tuesday morning, and I want to go on holidays and blah blah blah. So what do? Very, very tempting to take the profit, and as I know, well to my cost. But the really good traders don't see it that way. They want to be right, and they build this position and hang on to it for the 10 big figures they're talking about. And they make 50 grand on a 20 grand account with very little risk. So on a medium-term basis, that's what I'm talking about by building a position. We need, you do need to have a little bit of luck, and most traders starting off, you probably don't have the experience to know maybe when a move is starting to develop and how far it's likely to go and how these pairs generally react, and that takes a little bit of time for you to get to know that. But there's probably enough information out there already with all of the strategists and analysts and economists and all the blogs and what have you, telling you where the market's likely to go, giving you all of the information. But all of that information without this particular skill, I believe to be pretty worthless. So this is, looking at, the space I work in with the funds management space and what the investors are looking for. They're looking for this skill, the skill to turn a good idea into a lot of money. And that's, I believe, the art of the position builder. So you're going to need to be a bit lucky from time to time, but the harder you work, the luckier you get, according to Gary Player. He should know. So that's a medium-term type position. Now let's look at a very short-term position, and that's like a more shorter-term trade, and this is the Aussie dollar on the 1 hour. Now this is going to be a little bit different because if you're trading off, even off, let's call it the 30-minute charts. So you're trading off the 30-minute charts. You're not going to be making 10 big figures. That ain't going to happen. And you're probably not going to be making, it's going to be a slightly different mindset, but nonetheless, I think the same approach should apply. We probably should have started with this, half an hour earlier and just built a live trade on the, like on a 15-minute chart. They'd come up with a view, but for mine, well, like in my humble opinion, most of the time, and most of the really good intraday traders, they make their money on the range. So they play the range, and um, as we know, most of the time the FX market likes to find a range it's comfortable and stay in there. So if that's the case, so here we have the top of the range up at 77, the figure on the hourly chart, bottom of the range down around 76.30, and we know that there's a major technical support level there on the, I think there's a 61.8% retracement there. There's asset managers reportedly buying down there. So we know there's good support down here. Maybe you've got a slight bullish bias, but nonetheless, I think the really, really good day traders are able just to suspend any opinion that they may have, and then just trust the range. So they say we're going to trade the range. So how are you going to make some money trading the range in the Aussie dollar? So actually, if you excuse me for a minute, let me go back to this 15-minute chart. So the levels we looked at were up here, so the 77, the figure, and down here, say 76.40. So what you want, I believe, the best way to do it is you want to be agnostic to the direction, and you want to be increasing your risk during the session. So let's see what happens. You decide, okay, let's just start. Again, I've got a let's say a $20,000 account. So I'm day trading. I'm day trading the Aussie dollar. So I can afford to risk $1,000 a session. Then let's say $500 a session. Yeah. So that's my initial risk. I don't want to lose any more than $500, and I'm trying to make maybe $700 to $800. So that's what I'm trying to do let's say that's my target every day. So we look at the Aussie dollar, and it's trading at where we were back up here now. So we're just going to have to make up some numbers here. So we know what the parameters are. 76 on the downside, sort of, let's call it 20. So if it breaks below 76.20, we don't know what to do. If it breaks above 77.10, we don't know what to do. But in the meantime, we're going to trade the range. I'm willing to risk $500. The market's trading at 76.50. What do I do? Let's say I buy 100,000 at 76.50. Two things can happen. The market goes down. I can risk $500, remember. So the market goes down to 76, the figure, and I lose my $500. I'm out. So that's one thing that can happen. The second thing that can happen is the market goes up. Well, the third thing can happen, market does nothing and goes sideways. So that's certainly possible. But let's just say, for the purpose of this, the market is, and let me just write over here, range. So we've got our range parameters. So we expect it to stay say 76.20 to 77, the figure. And really, in my experience, and I've been trading this for donkey's years, an 80 pip range in the Aussie, certainly during the Asian and London sessions, is probably pretty normal. In fact, it might be a bit more than normal. So most sessions, for 2 sessions for the Aussie just to trade 80 pips is sort of pretty standard. Anyway, on this particular day, I say I'm going to trade the range. It's open at 76.50. I have a slight bullish bias for whatever reason, and I buy it. Okay, so now it goes down. Let's say it goes down to 76.40. What do? Do you take your $100 loss, or do you add to the position? First and foremost, I'd say never add. I mean, if you add to the position, let's just say, for instance, you buy 100 at 76.40. Hang on, let me just get rid of these, just to make life a little bit easier for us. So let's just say, for instance, you buy 100 at 76.40. You've now got 200,000 long at 76.25 or 76.45. But I can only risk $500. So that's 25 pips I can risk. So I've got to put my stop loss at 76.20. And the range I'm saying here is the bottom of the range is 76.20. So that makes absolutely no sense to place this trade. That's, so we definitely don't take that one. So we leave that. Now let's just say it goes down to 76.25. Do we buy? So now I'm 200,000 long at 76.37.5, and I can put a 25 pip stop on that, which puts my stop at 12.5. support is at 20. So that's only 8 pips below. Oh, that's cutting it very fine. So it's, that's only a little bit of just a little bit of a false break and my stop gets done. Yeah, I don't like that one either, to be honest. I just don't see a lot of value in that. So I think what I'm saying here is if I decide to buy at 76.50, my 100,000, then I'm leaving my stop at 76 the figure, and I'm just leaving it at that. So downside, basically, if the market goes down, I'm not doing anything. But let's just say the market goes up, and it goes up to 75. So what am I going to do? I'm going to sell. I'm going to sell at 76.75, and now I'm 100,000 short at 77 the figure. Very good. That's the top of my range, and I don't even have to risk five. Remember, the market is now trading at 76.75, so I could have my stop loss now at 77.50 on the top side, but yeah, I mean, I can have it a little bit lower than that. So in other words, I can say to myself, well, at this stage now, I'm lowering my risk to $300, $350 or something. I'm lowering my daily risk and see what happens. So, and now I start day trading. So the market goes down a little bit, and you'll find a lot of people trade like this. I don't know. I mean, I don't have the energy to do this anymore. And there's a lot of algos, particularly, who trade this way, who just trade the range, and they just trade sort of 10 pip and 15, 30 pip reversals. So yeah, I'm going from long to short. Remember, I'm agnostic. The only thing I'm interested in now is movement inside of this range. So now my position, I've sold 200, I've bought 200, I'm 100 long at 76.30. And I've got my stop now at 76 the figure still, 20 pips below here, and my loss has been reduced to 300. My loss potential down to 300, so it's gone from 500 to 350 to 300, and we see what happens, and it goes back up to 75. So I sell again, and I could, continue to do this for quite a while, and that is, I think, the art of day trading. The most important part of it is you've got to be agnostic to the direction. If you are, it's okay to have a mild bias, but in fact, you're better off without the mild bias. You're better off just to not care which way it's going. So you've sold 200, bought, sold. We're going to buy back again here, but now let's just say we buy back. Let's say it goes up a little bit, it pulls back. I'm not too comfortable, but I'm always trying to make a little profit. I'm just even 5 pips. So now I'm 100 long at 76.20. The market's trading at 70. I've made $500 for the day, but I'm not finished yet. And I'm going to keep doing this until such time as this range breaks. And you'd be surprised how seldom the ranges break, like that it can take 3 sessions. And can you imagine how many times you might be able to trade? So let's just say you sell. You can't. The thing with the day trading is you can't increase your position size too aggressively. You just got to find which what works for you. So now at this stage, now look at market's trading at 76.82. I'm $150,000 short Aussie at a stop at this level, and I've probably got a stop at entry. I'll probably at this stage have lowered my stop to entry, so I've gone now to a risk-free position. So now I'm just, if I get stopped out now, so be it. And remember, okay, I could, because I've got a little bit of, I could potentially, let's just say it goes up another 10 pips, or it goes up to 95, let's just say, and we see, am I willing to take this trade on? So I'm now 300,000 short at 77.10, and I could put a 10 pip stop on that, and it's still well above my range top, and it's giving me a little bit more risk. Absolutely. So I can take that on. It's as long as my parameters are staying in place. So in other words, I've had my range trading hat on, and as long as as long as the ranges hold, and I know what my monetary risk is per trading strategy or per trading session, whichever way you want to look at that, then yeah, I can just continue to do this. Now, okay, I might get stopped out and I lose $300, and that's tough luck, and that's a bad day at the office. But let's just say, it just goes all the way back down to suddenly we get a stop loss run that gets hit lower, and we can now maybe we get a little bit lucky in this case and we buy back at 76.50. So now I'm 100,000 long at 74.72, and even if my stop gets triggered at 76 the figure, I'm going to make $1,300. So what I've done by all of this, I've reduced. Obviously, I'm taking a risk at the beginning. You're always taking a risk, but I'm not increasing my risk at any time. I am through just using the whatever strategy I've got in place. In this case, it was a day trading strategy to trade this range, and I've used that, and I'm going to trade just any movements that the market gives me. The market's going to give me some volatility, and I'm going to use it to build up a position. So I hope that all makes sense. So again, of course, in this case, you have to have a strategy, just like I had in the sterling Swiss, a bullish medium-term strategy. In this case, I'm a day trader of the Aussie dollar, and I think it's going to trade in an 80 pip range. Whatever the strategy, I've set on my strategy, I've agreed with myself what my risk is for this particular. Note the difference here. So the risk here was I'm day trading the Aussie, I'm risking $500 a day. The sterling Swiss, I was only ever willing to risk $1,000 on this idea, because I get lots of ideas. So I might be getting 3 ideas a week. So am I willing to risk $5,000 on each idea on a $20,000 account? Oh, that's suicide, financial suicide. So am I willing to risk $1,000 on each idea? Yeah, I say okay. Yeah, that seems reasonable. So I've risked $1,000 on this idea, and I've risked $500 on this trading session. So yeah, slightly different, but in a way, it's pretty much the same. So I hope that made sense. So again, let's go back here to the slideshow. We talked about the size of entry position. So the size of entry position is directly correlated to this monetary risk we decide to take per trade. So there's an absolute direct correlation. So once you decide what your monetary risk is, and that's going to tell you what the size of your entry position is, and then you're going to go and build a trade. And this is what we've been talking about over on the two positions, the sterling Swiss and the Aussie dollar, and this is the fun part, especially if you get a fast moving market and you're on the right side of it, and you can just leave what I call silly orders. If the market's going your way and you can see people getting stopped down, you say, well, it's definitely not going to go there, so that's where I'm going to leave my stop. Well, that's where I'm going to leave my sell order. I'm long, and the market's panicking and it's stopping itself out. And how many times have you walked in and you've been stopped out of a position on some stupid move? So now we want to reverse it, and we want to be the guy who's either buying the dip on that stupid move or selling the rally on that stupid move. And that's that is the fun part of trading, when we're able to get ourselves into that really, really strong position. Ain't going to happen all the time. So for instance, on these types of trades, these sterling Swiss type trades, I might get 2 of them a year in a good year, and that's the sort of trader I am. This is what I'm looking for all the time. So I'm constantly looking for this, at least a 500 or 700 pip move, and in fact probably more, 10 to 15 big figures, and they happen quite regularly, especially across all of the crosses. But you just got to find them, and not only find them, then you've got to be convinced that it's a good idea. It's one thing somebody telling me a trade's a good idea, but I've actually got to believe it's a good idea. Otherwise, I'm not going to trade it properly if I'm just listening to somebody else's advice. So yeah, look, it's definitely a rewarding and a fun experience, but it's not easy. If it was easy, everybody would be doing it. So look, I think that's about does it for me for today. I hope that was of some help to you. I'm sure there'll be lots of questions, and yeah, I'm gonna call it there. So please shoot with as many questions as you got. So thanks for your time.
Okay guys, we're just going to run through a couple quick questions. We'll take small breaks in between. So question was asked, are your stops placed in the market as hard stops? Yes, they are placed as hard stops. Now, in terms of how do you pick which FX trade, any guidelines? Look, as Sean mentioned, there's analysts that will give opinions, but essentially it is your own choice at the end of the day which pair you go with. Now, in terms of the slides, as you can see, a lot of you guys asking about the slides as well as the Excel spreadsheets. We will have those available. What you can do is you can email myself. So that's c.mar@fpmarkets.com.au. I've got it up on the screen there for you. Now, why not show your stop loss position and running profit loss on the spreadsheet?
Sorry, none of your business.
Yes, we don't actually have that on the spreadsheet, but it is potentially
that's my own proprietary.
Yeah, it's potentially something we could look into. Now, this session will also be recorded, so you'll be able to go back and have a look over the session. Any questions, like I said, you can email them through to myself, c.mar@fpmarkets.com.au, and I'll liaise with Sean and see if we can get an answer back for you.
Of course, but with the monetary stop loss always stays the same. Yeah.
Hi, another question was, with your first trade when you were scaling in, didn't that either increase your risk or reduce your stop loss? So although it can increase your risk by managing and reducing your stop loss, then in turn manages that risk.
Yeah, so it is going to increase your risk. Yeah, and you do need to adjust your stop loss.
Yeah, most importantly, it will increase the risk, and you just need to adjust that stop loss. Look, another question was around the second range trading strategy, and whether he would consider longer term timeframes. I mean, it is something, but the purpose, there's so many different strategies. The purpose of a range trading strategy is purely to almost ignore the direction, and what you're wanting to do is you're wanting to sell at the highs and buy at the lows and have that predetermined range that you're looking to take advantage of. Now, just in terms of the webinar itself, if there is any other questions, you can send them through to c.mar@fpmarkets.com.au if you want to keep those at your own discretion. We won't hold you up too much longer, but I thought I should let you know, with all our new MT4 accounts, there is that bonus available. So for a $200 initial deposit, it's $75 trading bonus. $1,000 initial deposit, a $250 trading bonus, and $5,000 initial deposit. That'll get you a $500 trading bonus to allow you to exercise some of the things that Sean has taught today in the webinar. And one other thing I'll also mention is as the earlier slides mentioned, we are offering Bitcoin now. Now, I'd like to thank you all for coming out today. It's been a great webinar, and hopefully we're looking to get Sean on again in the near future. So hopefully we can